Thank you. Thank you.
Thank you, Justin, and good morning, everyone. Very pleased to be here again this year. So my task this year was to talk about content, talk about streaming, and talk about the interplay of content, streaming, and advertising, and what it means for local players and indeed the future of television, both in Canada, of course, and further afield. And when I sat down to start making this presentation, I thought about all the presentations I've done over the last 30 years. And everything, of course, goes in cycles. And so you present, and each year it's a little bit different, and suddenly there's a sea change, and everything is different. And I think we're at one of those points now, and that's why I've titled this presentation, What a Difference a Year Makes. So TV's new reality. So let's start by setting the scene. A TV business challenge people are facing, broadcasters are facing, and that challenge is unique to nobody. And that challenge, of course, is competing with global scale. And I noticed on LinkedIn that if you put big bubbles and little bubbles on a chart, you get about 100 times more likes than if you don't have big bubbles and little bubbles. So my first slide is big and little bubbles. Scale, Comcast, Netflix, 30 to 40 billion. This is all just TV revenue, by the way, nothing else. Disney, about 20 billion. Warner, Amazon, Paramount, 10 to 15 billion in annual TV revenue. And then, of course, you have the local Canadian players knocking around the 1 to 2 billion mark. So that is the competitive dynamic that is happening in every country. And of course, competitive scale translates to programming power, and that is all important when we're talking about television and we're talking about eyeballs. So those global major players spend $111 billion a year on content. Local Canadian players, about 3. That's the difference. But if we look at local content spend on Canadian-produced television, then all of those big major streamers together spend about the same as any one Canadian local player. So the picture is not entirely simple. What about viewing? Well, the good news is viewing is not declining. In fact, it's gone up about 15 to 20 minutes over the last 4 to 5 years. But you can see that the shifting dynamics between linear, that yellow downward line, and all forms of streamed content, including, to be fair, local streamed content. Hidden, though, within that chart is a decline overall for traditional players. So although it appears that with streaming their viewing time is still going up, there's a hidden trend there whereby even with their streaming platforms, traditional players are beginning to lose market share. And you can see that very clearly in the bar chart. On a per service or per channel basis, all of this is Canadian data, by the way, you can see that the big streamers now are achieving very significant monthly viewing relative to the local players. And what that means overall is that we've just had an inflection whereby Canadian linear, traditional, whatever you want to call it, local TV, local controlled TV, including the streaming platforms of those local players, has now been just overtaken by AVOD and SVOD global streaming viewing. So that's Netflix, Amazon, Tubi, etc., Pluto. And that pattern actually contrasts to some of the big Western European markets, where linear broadcast, traditional local broadcast, plus catch-up plus the streaming services of those broadcasters is actually still greater than SVOD and AVOD international put together. So the dynamic is not a given that global players are overtaking local. But what the situation is in Canada is, and I've said for once, because scatter plots are usually quite difficult to interpret, but this one rather elegantly illustrates the Canadian situation. We have the streamers all below the line attracting a much younger viewer base, the really big streamers like Netflix attracting a very big viewer base, and all of the local players in the top left, older, lower viewing on a per channel basis than some of those big global streamers. So what about advertising spend? What's been happening there? Well, first of all, you can see that when we think about non-traditional, non-television ad spend, most of it is still going to social video, so Google and Facebook. That's the big fat purple block on those bar charts. The single hottest topic of the last 18 months, FAST, is taking about 2% of ad revenue at the moment. So a very, very small market, despite all of the conference sessions you've no doubt been to and seen about the future of fast streaming linear television. So relatively small in Canada, relatively small actually in Western Europe as well. TV, about a third of all ad revenue or all video ad revenue, declining by 2027, we believe, to about 20%. But despite that shift, locals still control the lion's share of direct TV revenue. And by direct, I mean either from streaming or from advertising. And that, of course, is because they still control that broadcast space, which is still a very significant part of the market. But given the sea change in streaming that has now moved wholesale into advertising, and it's easy to forget that just 18 months ago that was not the case, we think that streamed advertising, including the global players and the local players, will be catching up to, not equaling, more traditional advertising by 2027. You can see there the coloured blocks at the top are the global streamers. The big blue block is the local proportion that is going for streaming. But there are headwinds. So again, this is one of the big things that has changed in the last year. Yes, viewing shift is going to streaming. Yes, locals are competing for global scale. That global scale has been driven by significant content investment. So what happens when that goes into reverse? And reverse is exactly where it is going, because as from this year going forward, content spend after more than a decade of exponential growth is going into decline. -2% globally, -9% in the USA. And then, of course, there's the small matter of that strike across the border. My prediction when this whole thing started was an end date of October. That's looking possibly optimistic now. But if the strike does end in October, even by Q4 next year, 50% of TV shows that would have been made will either have not got made or be delayed significantly as a result. So there is a major impact on US production. In every negative, there's a positive, a silver lining. Two positives for Canada. No sign of resolution to the strike in the US. Yes, Canadian production is impacted, but it could lead or should lead to an upward swing in inward investment to non-US markets. And of course, there's a change to legislation in the pipeline that will see global streamers coming under the same regulation as local players. And while Canada is not immune to the downturn, you can see that it's dipped slightly in terms of commissioning activity in Canada. It has not dipped anything like as much as the US market. And even before the strike, global players had anyway made a strategic shift. So you can see in just 3-4 years, down from 50% of orders for new TV shows being made in the US to around 30%. So internationalization of content. And again, as every cloud has a silver lining, there's a flip side to that as well. Up to 60% of streaming commissioning activity is shielded to some degree from the US strikes because they're not making it in the US. And Canada, too, is a beneficiary of that internationalization. And of course, we love top 10s, and Canada has messed up my slide because Canada is number 11, so I had to squeeze 11 on here. But basically, global international commissioning activity by the streamers, top 10 international markets, does not include Canada, but top 11 does, so it's number 11 there. So beneficiary of that internationalization of content. Of course, locals still commission far more locally, but the spend per series is much, much higher among the streamers. So you can see there between 10, 20, 30, 40 million a series compared to sort of 2 to 10 for the local players. And why does that matter? Well, budget does impact viewing. 46%, or almost half of the top 100 most popular shows on TV, not just streaming, on TV full stop, are controlled by global streamers. And of course, content remains central to pushing forward the competitive dynamic. So, what are global streamers up to in terms of making their offer and their content and their television more local? And thus, where are they most directly competing with local players? If we look at their commissioning activity and we compare it to the local broadcasters and media groups on the left, you can see that there are a couple of areas where streamers are particularly focused for Canadian local content. One of those areas is children's content, particularly for Warner and for Netflix. And the other area is crime, which is a big focus for Amazon locally, and thus that is where they are most overlapping with what the local players are commissioning. And in unscripted content, I should have said previous slide was scripted, quite low volumes, so this is no firm conclusions to be drawn from this, but basically reality TV and documentary is what the streamers are making and commissioning locally in Canada to compete with the local players. So what does all that add up to? We've talked about a changing dynamic in content. For the first time in more than a decade, content spend among the global players is flat or in decline. The volumes of content that they are making are down, but the volumes of international content, including Canadian, is up. They are punching well above their weight in terms of viewing share, and they have just entered the advertising market wholesale. So the competitive dynamic has changed out of all proportion compared to 1 or 2 years ago. And we can see that the strike and the downward trend anyway in content because of global economic outlook is going to have an impact on their competitive dynamic. So what are the implications for advertising? At the moment, because they are new entrants into the ad space, global players are punching below their viewing and content weight in terms of their ad revenue share. The focus among brands and buyers for digital, in inverted commas, ad spend is still on social media and social video. But there are content headwinds, and strategic changes mean the competitive threat to local players is temporarily weakened. So there's a window of opportunity to shore up defences. But it's a very short window because, as we saw from some of those early charts, ad spend migration to streaming will now accelerate rapidly. And so for local players, it's all about focus on content strategy, understanding where streamers are putting their money, understanding where the demographic and viewing shifts are, and redressing the balance that we saw in my self-titled elegant scatter plot about where the audience is segmenting between streaming and local players. And this slide is just for me, because I'm getting old and I will forget to say, next slide is a QR code. If you want to download the slides, please get your phones out, scan the QR code, put in your email and download them. Hopefully that was a nice little introduction to what's happening in terms of content streaming and advertising in Canada and globally. Thank you very much.